Hello and welcome to AI Market News by LM. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Okay, welcome to the deep dive. If you're feeling the sort of global news whiplash this week, well, you're definitely not alone. Our sources today are really pulling us in quite different directions. We've got this sudden, almost stunning relief from a major geopolitical breakthrough, but it's running head-on into some pretty critical warnings about a looming market correction and, central bank caution. We're sorting through a lot today, everything from a really delicate peace deal shaping up in the Middle East, and these AI-fueled record highs over in Tokyo, right down to some big shifts in EV strategies for major automakers. So our mission here is to try and connect these dots for us quickly and thoroughly. We want to understand how a huge, really emotional geopolitical event can instantly dial down regional risk. Even while policymakers in the US and Europe are waving these huge red flags about whether current asset valuations are actually sustainable.
Yeah, it's really a study in contrast, isn't it? Different speeds. And that's what makes this input so crucial right now. We're watching markets grapple with profound political uncertainty and these deep structural risks all at the same time. For anyone tracking global indices or, say, major currency pairs like the euro-dollar, understanding whether today's move is driven by genuine relief or maybe just fundamental strength is absolutely essential.
Okay, let's unpack this then. Starting with the headline that really seemed to reset the global risk thermostat almost instantly, that's the major Israel-Hamas ceasefire agreement. So the news broke on October 9th, 2025. It confirmed that after some pretty intense mediation led by the US, Qatar, and Egypt, Israel and Hamas had agreed on the terms for phase one of a longer-term peace plan. I mean, this feels like a massive diplomatic shift after what's felt like just endless conflict.
It really is. And the specifics of phase one detail a very significant exchange. The agreement calls for the release of all the remaining known hostages, that's about 20 thought to still be alive, plus the remains of roughly 28 others. And in exchange, the release of approximately 2,000 Palestinian prisoners. This framework, well, it was largely based on that 20-point proposal that had been sort of circulating among diplomats over the past week or so.
Right. And while the immediate tangible result is, getting citizens back, the internal politics are clearly very fraught. Israel's deputy foreign minister confirmed the ceasefire was effective as of noon local time, but also acknowledged the immense difficulty and the mixed feelings over releasing convicted terrorists. It's a painful political trade-off, no matter how necessary it might seem.
Absolutely. But setting aside that political difficulty for a moment, the market reacted with something close to euphoria. It signaled a really sharp reduction in that regional risk premium. Israeli equities saw the second largest global gain of the session, and the shekel surged, hitting a 3-year high against the dollar. That move reflects investors suddenly needing much less compensation, or less premium, you could say, to hold Israeli assets, because the risk of immediate regional escalation just dropped significantly.
Okay, but hold on. The sheer speed of that move and the shekel hitting a 3-year high, doesn't that seem like it's discounting a lot of the danger that's still there? The sources mention several massive sticking points still: Hamas disarmament, the whole future governance and reconstruction of Gaza, even the final details of the prisoner list. Aren't investors kind of ignoring a huge amount of downside risk here, betting everything on phase one just going smoothly?
That is the critical question. The relief is definitely palpable, but I agree, it feels tentative. If we connect this to the bigger picture, well, the market is buying the headline news, but the long-term fundamentals haven't really shifted yet. Until those sticking points, especially who governs Gaza and the immediate need for massive humanitarian reconstruction, until those are resolved, any market gains, globally and regionally, probably should be viewed cautiously. I mean, look at safe havens. The initial relief rally was pretty minor. Gold pulled back a bit, yes, but it's still sitting comfortably above that psychologically important $4,000 mark. That tells us the underlying systemic anxiety hasn't just vanished.
That makes perfect sense. The market gives with one hand, takes away with the other, maybe. Now let's pivot hard over to the US. Because there, the macro signals are far less clear, and skepticism seems to be mounting, even after a fresh rally. U.S. equity futures, we're talking S&P 500, NASDAQ, they were pointing fractionally lower in pre-market, basically taking a breather after yesterday's solid performance. The S&P climbed 0.6%, NASDAQ added 1.2%.
And let's talk Fed signals for a second. We had NY Fed President John Williams giving some support to the idea of more rate cuts this year. His comments specifically focused on the risk of a further slowdown in the labor market, suggesting the Fed's attention might be shifting a bit from inflation risks more towards employment health. And that aligns with current investor expectations, which, are still pricing in 2 more rate cuts in 2025, probably October and December. We even saw some high-profile forecasts like the Mizuho FG CEO predicting 3 cuts by January 2026. That underlines this sort of dovish sentiment.
Okay, but here's where it gets genuinely confusing, I think, for the everyday investor. Because we have this rate cut optimism running right alongside truly dire warnings about the market structure itself. JP Morgan CEO Jamie Dimon sounding the alarm. He's stating the risk of a serious fall in U.S. stocks is higher now, suggesting maybe a 30% correction chance. That's significant.
It is. And that warning is echoed overseas, too. The Bank of England, the BOE, explicitly warned that the current AI frenzy and the heightened valuations that come with it are setting the equity market up for a sharp correction. Their words. We can sort of see this tension reflected in how volatility is priced. The VIX index that measures market fear, basically it's back below 16.5. Now, that lower number might suggest complacency, almost mirroring the AI euphoria the BOE warned about. Historically, when the VIX drops maybe too low, it often comes right before a sudden spike in fear.
So, okay, we've got Wall Street pricing in cuts, which is usually bullish for asset prices. But at the same time, 2 of the world's most powerful central banks, plus a key financial CEO, are warning the whole structure could crash. How do we even begin to reconcile those 2 opposing views? It feels like whiplash again.
It's a real dilemma, and it seems driven by conflicting timelines, perhaps. The Fed, well, they're looking at maybe a 12-month horizon, focusing on managing the economy through a soft landing, using rates, Dimon and the BO. They seem focused on the immediate structural risk created by how narrow this AI rally has been. They're essentially saying, yes, the macro picture might support cuts eventually, but the current valuation bubble could pop much, much sooner. And that could cause massive damage regardless of what the Fed decides to do in October or December.
We're seeing a classic sign of European stress reflected in the currency market too, aren't we? The 10-year U.S. Treasury yield is holding around 4.13%. The dollar index is kind of flat. But the euro D pair is weaker, trading around, 1.16, 1.1617?
Exactly. And that euro weakness is a pretty direct reflection of political risk. We've seen this ongoing French political gridlock. President Macron struggling to name a stable prime minister by that Friday evening deadline. Now, after a series of budget crises, when major European economies face that kind of instability, capital tends to flow out of the Eurozone. And where does it go? Into the perceived safety of the U.S. dollar, even if the U.S. has its own fiscal noise going on. It's almost a default flight to safety. Reinforces the dollar's dominance and puts pressure back on the euro.
Okay, now let's bridge that skepticism over AI valuations in the West to the, outright euphoria we're seeing in Asia. The very same AI frenzy the BOE is warning about seems to be propelling indices in Japan to new record heights. Specifically, the Nikkei 225 surged 1.8%, hit a new historical high, 48,580.44, and this move seems fundamentally driven by tech and robotics enthusiasm.
Absolutely. The engine room for that surge was SoftBank Group stock. It rocketed up 11%, and that was after they announced a major acquisition, buying ABB's robotics business for $5.375 billion. Now, this isn't just a simple M&A deal. It's seen as a huge vote of confidence in the future of AI and robotics, and that just boosted sentiment across all related Japanese technology firms.
Right. Yet the flip side to this record equity market is this profound currency weakness. The yen weakened to an 8-month low. It briefly hit the 153 level against the dollar. Now, that sounds great for exporters, sure, but what's driving that persistent selling pressure on the yen?
Well, that selling pressure stems pretty directly from expectations of aggressive stimulus under the new political leadership. Some strategists have even dubbed it Sononomics. To break that down, it essentially means the government seems poised to prioritize radical fiscal spending and maintaining extremely loose monetary policy, all to try and pull Japan out of its decades-long stagnation. When a central bank keeps interest rates near zero, while others, like the Fed, hold theirs much higher, the currency, in this case the yen, weakens dramatically. Capital chases higher yields elsewhere. Some strategists are already eyeing 155 yen to the dollar as the next key psychological target if this trend continues.
That weak yen is such a classic double-edged sword, isn't it? It's phenomenal news for massive Japanese exporters. We saw Fast Retailing, that's Uniqlo's parent company, projecting a 5th consecutive record operating profit, 610 billion yen. and they're aggressively capitalizing, planning to hit 1 trillion yen in sales in both the US and Europe soon.
Absolutely. The weak yen makes their products cheaper, more competitive overseas. That's the upside. But the flip side, which is critical for local consumers in Japan, is that a weak yen makes imported goods, things like food, energy, raw materials, significantly more expensive. It fuels inflation domestically and really hurts the average Japanese household's budget. It's a painful trade-off between corporate profitability and consumer spending power. And speaking of confidence in Japanese corporate health, it's worth noting Warren Buffett's Berkshire Hathaway. They demonstrated continued long-term faith in Japanese corporate governance by increasing their stake in Mitsui & Co. to 10.12%. It tells us that even with the currency risk, the underlying fundamentals of these major Japanese trading houses are still seen as pretty sound by some major players.
So Asia presents this really complex picture then. Strong corporate governance, massive AI investment leading to record highs, but all at the structural cost of extreme currency vulnerability. Which leads us right into our final theme. These major strategic shifts happening in key sectors like auto and finance. Let's look at the auto industry first. It seems like the initial, maybe breathless enthusiasm for total electrification is cooling off a bit, forcing a major strategic pivot, especially among luxury makers.
That pivot is definitely key. Take Ferrari, for example. They drastically reduced their 2030 target for full EV composition, slashed it from 40% down to just 20%. And critically, they doubled the planned share of internal combustion engine vehicles, ICE and hybrid models, to 40% of their lineup. Now, analysts tend to view this positively because, for a luxury brand like Ferrari, those ICE models still carry vastly higher profitability and margins than EVs do, especially while the EV tech is still evolving so rapidly. It looks like they're prioritizing margin over maybe a mandated market share target.
And we're seeing governments acknowledge this difficulty too, right? Germany's government is actively supporting its auto industry $3 billion in zero-emission vehicle incentives through 2029, and they're actively seeking to ease the European Union's, controversial 2035 combustion engine sales ban. This suggests a growing recognition across Europe that maybe the timeline for a full transition was perhaps economically unfeasible or just too aggressive.
Yeah, that pragmatic shift back towards hybrid and ICE profitability is a really big structural change. It's going to affect suppliers and manufacturers globally over the next decade for sure.
Okay, now for a completely different kind of modernization shift, this time in Japanese finance. MUFG is making a major move by entering the digital securities market, often called security tokens, or STs. They're issuing a 10 billion yen subordinate corporate bond as the first public ST issuance by a major Japanese bank.
This is a huge signal about the future of finance, potentially. For those listening, think of security tokens simply as taking a traditional asset like a corporate bond or maybe a piece of commercial real estate and digitizing its ownership record using distributed ledger technology, DLT, which is essentially a fancy term for blockchain technology. The idea is this allows the asset to be traded more efficiently, maybe more transparently, often 24/7/8. MUFG's entry, joining existing efforts by firms like Nomura and Daiwa, signals that this ST market is rapidly becoming mainstream in Japan. It's projected to expand significantly, potentially reaching 2.5 trillion yen by 2030 in Japan alone. This tokenization of assets represents one of the most significant structural shifts in how corporate finance might operate, particularly in Asia. So, to sort of summarize the core tension of this entire deep dive, we saw a major geopolitical risk subside, right? Granting immediate relief to regional markets, causing a small dip in safe havens like gold, but simultaneously these macro-level risks seem to be mounting. We have central banks and major CEOs openly cautioning against asset valuation bubbles, largely fueled by this AI frenzy. And meanwhile, the extreme weakness of the yen highlights the severe vulnerabilities created by domestic political choices and monetary pressures.
Yeah, underscoring the key takeaway for us, I think the market right now feels like it's being pulled apart by two fundamentally opposing forces. On one side, you have this unbridled, record-setting AI enthusiasm, especially visible in US tech and Japan. But on the other side, you have explicit deep caution and these stark warnings from major policymakers about a looming correction risk. This isn't just conflicting noise, it feels like a genuine crisis of confidence in valuation itself, which raises a really important question for everyone holding assets right now, doesn't it? Given that both traditional safe havens like gold and the yen and the current high-growth sectors like AI stocks are facing unprecedented volatility and these political pressures, how fundamentally has the definition of a safe investment actually changed in this complex, almost two-speed global economy? What asset truly protects capital when the traditional hedges seem unreliable and the growth engines are being called bubbles? Definitely something to mull over this week. Thanks for watching. Don't forget to like and subscribe.